All right, good afternoon, everyone. So a couple quick announcements before we get started. So I think it's almost over. Yeah, basically by the time the class is over, the reality fair will have been gone. But I posted this earlier today just as another reminder. Hopefully you got some snacks at least while it was available. October 1st, there's going to be a networking event. This is primarily geared towards finance and economics students. This is going to be a great opportunity to meet with some executives. So if that's something you're interested in, highly recommend attending this. Local employers are going to be here. A lot of these companies hire directly from MTSU, and this can be a great opportunity to meet with some of them. Right, first round of grades were in. They're looking good on average, kind of on track. I did notice a general trend where quiz scores tended to be lower for people who didn't use all 3 attempts of their homework. So if you didn't start doing that at this point, I definitely recommend you use all 3 attempts of your homework before the future rounds of assignments. I guess I can keep talking while the computer's restarting. Use all 3 attempts of your homework before you move on to your quiz. It's just going to help prepare you. So yeah, definitely do that. It is very helpful. So the plan today is we're going to be talking about bonds. Talk about it for a little bit without PowerPoints. Actually, I could probably talk about the whole thing, but I know people prefer looking at the screen than listening to just me talking. So just give this another minute to go. Any comments or questions about the assignment so far? Yeah.
Go ahead and turn it off because it's just sending error information. There's nothing restricting.
Oh, it needs to restart. Okay.
It's collecting info, and then it'll restart, but you can just restart it right now.
I've been told very ardently by ITD that we're not supposed to turn off computers in here, so I'm kind of trained not to touch anything.
Oh, really?
Yeah.
What display is that? Like, is it like an inlaid display on the table?
Nope, it's just a computer monitor down here.
Oh, I was about to make a comment. I did wish that I did all 3 attempts. I did okay on the quizzes, but I realized that a lot of the questions that was in them homeworks were repeated in the quiz.
Yep.
And I was like, damn.
That's why I use all 3 attempts, yeah. No, I'm glad you mentioned that because that's the exact reason why I suggest it, right?
Yeah.
Like the computational questions, those are random per question, so they'll change a bit, but the general things you got to do are the same for homework and quiz, and same on the exam. So
Yeah.
the more you practice, the better you're going to do.
Yeah.
Any other questions or comments?
I expected the quiz to be longer than they were.
Yeah.
I was like prepared for like a 20-question quiz.
I was scared to open it up.
I was, and then like I overthought some of the questions, like the ERA and APR ones.
Yeah.
I thought that missed it.
People have a really common tendency to do that. Just kind of overthink and make it more of a problem than it really is.
Yeah.
That's very common, yeah. But right, we're basically dealing with time value for most problems, so just try to keep that in mind, you know, what belongs to what, cash flows that we're dealing with, that sort of thing. It's taken a while to reboot, so. I make it a habit to turn off the screen when I'm using passwords and that sort of thing.
Is it always like attendance like this like drops really bad after the first quiz day?
Usually not to this extent, but there's also a career fair going on right now. So I've gotten a couple emails about people attending that.
Yeah, okay.
So I figured that's a big part of the reason for today's attendance, but I don't know. So the funniest thing, so I'll teach, like, if someone wants to show up, that's the person I want to try to teach. But during COVID, I was teaching large sections of 3010 back then. And so they had me in Tucker Theater, which is huge auditorium, so people could spread out and that sort of thing. And by the end of the class, it was just one student showing up. So it was me in an auditorium for like 1,000 seats and one student.
Oh, wow.
But only show up for that student.
One of my other professors, I think it was for English maybe. After the first exam, nobody came to the class, and they had like clear doors in my old college, in my old university, so like students could see what's going on in the class. And one of my friends and we actually walked past the class, and we literally saw the professor lecturing to chairs. Like he was not speaking to anybody, and he was like,
Interesting.
yeah.
At that point, I would go home.
Yeah.
There's one student I'm teaching.
Yeah, I was like, yeah, that's kind of insane.
Chairs, I'll go home.
Yeah. Mm-mm.
All right, and we're back. That's pretty funny, though. Unless there's like a legal requirement that that is actually a thing, yeah. Like, I think even with tenure, professors can technically get fired if they don't show up for their own class. Yeah, so I don't know if it was a situation like that. All right, bonds, yeah. So this is what we're going to be talking about the next couple classes. So we're just going to be talking, right, what bonds look like, basically, different types of bonds, how we're going to value them, and then wrap up with a little discussion about bond ratings. All right, so what are bonds? Basically, they're loans, right? So we have people providing money, people borrowing money, right? So the people providing money are the creditors or the lenders, and they're providing the capital to the entity that's borrowing, right? So in terms of loans, right, we as individuals can take out loans. Companies and governments do the same thing, just at a larger scale, right? And so that's where the bond market comes into play. This is where a lot of companies and governments go to raise capital for longer term projects that they're going to be working on. All right, so the creditor or lender is providing the capital. The debtor or the borrower is the entity that's borrowing the capital, hopefully for productive purposes. Right, I think, we already spoke about, right, payday loans and all that thing. Right, taking out debt for productive purposes can be really valuable, right? If the return on investment is greater than the cost of capital, that's a good economic decision. But if people are borrowing for the sake of borrowing, that can be really detrimental to the entity that's borrowing, including at an individual level, right? Borrowing when it's unnecessary to do so, especially at high interest rates, can very often be detrimental for the borrower. Debt, right? This is just an agreement between the creditor lending the money and the debtor borrowing money that the amount borrowed is going to be paid back, usually with some form of interest. Very important to keep in mind that debt is not a reflection of ownership in a firm. Remember, when we're talking about equity or ownership, that's a residual interest in the cash flows that a company generates. All right, so debt is not a claim of ownership. It's a claim to cash flows up to the point where the debt is paid. Once the interest is paid, once the debt is repaid, then that's the end of the contractual claim with the debt agreement. Right? You can't pay more than you owe with the debt contracts. With equity, it's a residual relationship. It is ownership in the firm, and any cash flow that's generated past the other capital claims of the company are going to be attributable to the equity holders of a firm. All right, so that brings us to the main topic. We're going to be talking about bonds. All right, so a bond is just a debt instrument that's issued by governments or firms, and it's basically a structured loan agreement. Right, so whereas you might take on a single mortgage with a bank, a bond is a group of loans that governments or businesses issue. Right, so it's not just a single contract, it's a multitude of contracts. And very generally, bonds are going to be structured in similar ways when they're issued. Right, so when a company goes to issue a bond agreement, there's going to be thousands, if not millions, of individual bonds with each one of those loan issues. Right, and so that company then is going to use the aggregate capital from the bond proceeds in order to fund the project that they are interested in. All right, so what are the makeups of a bond? Basically, everything I'm about to talk about on the next couple of slides directly translates into time value that we've already talked about. All right, so first and foremost, we have the price, which is how much a bond is going to cost on the open market. Unlike equity securities, where you buy and sell on secondary markets very often, a feature that's very particular to bonds is that very often investors will purchase with the intent of holding to maturity, meaning they're just going to hold on to the bond until it ends. Whereas equity, right, there's something that we can buy and sell on secondary markets very often and very quickly. The bond market, though, is much more illiquid, meaning there's not as many people trading in it. Then we have the face value, or par value. This is how much a bond is going to be repaid at the end of the bond's maturity. Typically in the US, this is about $1,000. This is just kind of the standard way. Usually it's $1,000, $10,000, something in those level of increments. So unless I say otherwise, just assume that we're talking about a par value of $1,000. Right? In other words, future value. And we have the maturity, or the number of periods, how long a bond is going to be issued for. All right, there can be very short-term bonds. The U.S. Treasury will issue bonds at very short lengths. And then there are longer-term bonds where sometimes companies or governments will issue bonds with, say, 20, 30, 50, 100-year maturities even. All right, so we have present value, future value, number of periods. We also have the discount rate, right, which is the yield to maturity. So the yield to maturity, by definition, is the rate that is required in the market for a bond's price to equal its par value. In other words, it's the discount rate. Unfortunately, the bond market is pretty old. The terms that are used in the market don't necessarily line up with our modern understanding of financial economics. Bonds will sometimes have what's called a coupon, and this is just a regular payment that a bond is going to pay based on the stated interest for the bond, right? And so a coupon used to be a literal coupon, right? So, right, when people used to go grocery shopping, they might get coupons that would get them discounts. It was the same physical idea with bond coupons. It was literally something you would clip off of a piece of paper that said you're the bond holder. You would clip it off, go to the company, they would pay you. So the reason it's called a coupon is because that's literally what it used to be. Keep in mind, bonds don't have to pay coupons. It's just something that can be paid out, and it's something that people appreciate when they're looking for building up cash flows in retirement portfolios, right? Coupon-paying bonds, dividend-paying stocks. Very often we're going to be quoted the coupon rate, though, right? Because things aren't convoluted enough. So coupon is what is actually paid out, but when we're looking at a bond, very typically what you'll be told is the coupon rate, which is the percent of par that will be paid out as the coupon. So, like I said, everything we just talked, question in the back?
Yeah, so is that coupon like thing like specifically for like firms, or is it government too?
Yeah, government can as well. I think the government or the U.S. government at least typically issues pure discount bonds more frequently, but that is not restricted to just companies. Any other questions? All right, so like I mentioned, bond market is really old. Government bonds go back, I think, at least 1,300 years. I'm trying to remember. I recently read a financial history book, but I forget the timing on some things. But bond market is really old. It's one of the oldest capital markets in existence. And it's been around a very long time, including even before the first finance textbook was written in the 13th century. All right, so the bond market is extremely old. The terms that we use in it are similarly old, but everything we've talked about, like I said, just directly translates to what we've already discussed. All right, price we can think of as the present value. Face value, future value. That happens to line up pretty nicely. Maturity are the number of periods. Yield to maturity is the discount rate, and coupon is the payment that we're going to be making. Right, so there's a direct translation with every single component we've just talked about. It's just in the bond market, there are these specific names to each one of these individual time value components. All right, so a bond is referred to as fixed income, basically because the structure of its payouts are consistent across the bond's maturity. Right, so if you purchase a bond at issue, you know when you're going to receive the coupons if you're being paid coupons. You know when those are going to occur, and you know when the par value is going to be paid out. So you know the entire income stream and the timing of that income stream on purchase of that bond. Right, so that's why we refer to it as fixed income. So what does change with the bond is the bond's price in the open market if you were to purchase it secondhand. Right, and so there needs to be an adjustment with price if there's any change in the discount rate on the bond. Right, so when a bond is issued, we typically see that the discount rate is equal to the coupon rate on the bond. Right, the coupon rate is what you're going to be paid out in periodic payments. Right, so on issue, the coupon rate is equal to the yield to maturity. Once the bonds start trading on the on secondary markets, though, it's not necessarily the case that the coupon rate is going to equal the yield to maturity. Right, there's basically two general situations that we'll typically see. Either the coupon rate is less than the yield to maturity, or the coupon rate is greater than the yield to maturity. And if the coupon rate is less than the yield to maturity, then the price is going to be less than the par value. On the flip side, if the coupon rate is greater than the yield to maturity, the price is going to be greater than the par value. In other words, it's going to sell at a discount or at a premium. All right, so let's think about this economically, why this is going to be the case. All right, so imagine you're holding on to all right, let's say that you have a 10% bond and rates in the open market are 5%. In other words, interest rates have declined. Would you want to trade a 10% bond for a 5% bond? In other words, a 10% rate of return for a 5% rate of return? No, you wouldn't. Right? So in order for you to sell that 10% bond and go buy something at 5%, you'd have to be paid a premium to make that trade. Right? And that's what's going on here. If the coupon rate is greater than the yield to maturity, in other words, if the rate on your bond is greater than current market rates, you'd have to be paid a premium in order to let go of that bond that you're holding on to. Same thing in the opposite direction. If we look at it in the opposite direction, if you have a 5% bond and market rates are now 10%, who would want to purchase a 5% rate of return when they can go get a 10% rate of return? Right? And that would be why we would sell a bond at a discount, is because we would need market participants to purchase our bond if we're looking to sell it. But again, keep in mind, this is just on open market purchases. And very often when people purchase a bond, they intend to hold it to maturity. Right? So very often this is more corporate investment portfolios than individual savers and retirees. Right? But if we look at the market, we'll see bonds selling at discounts and at premiums depending on what their coupon rate was at issue and the going market rate on the bond. Right? So in other words, you can think of coupon rates as the stated interest on a bond or the contractual interest that the bond issuer has to pay. And the yield to maturity is the market rate of risk, or the market interest that is currently occurring. But bond issuers are contractually obligated to pay whatever their coupon rate is on a bond. That's what I was just talking about. All right, so when we're thinking about bonds, we can think of them as basically either being annuities or pure discount bonds. Right? In other words, if it's an annuity, then we have regular payments that are being made. If it's a pure discount bond, then it's just a future or a present value problem that we started off this class discussing. It's very typical for U.S. bonds to have semi-annual interest, right? We typically assume annual interest unless otherwise stated. When we're dealing with the bond market specifically, you can assume semi-annual interest. All right, so some more particulars about bonds. So the indenture is the agreement between the borrower and the lender that's giving you the information about the issue, right? So the terms of the bond, right? What's going to be the price, what's going to be the coupon, the maturity, the yielded issue. How much are we going to be raising, right? If we're issuing $1,000 bonds, how many of those bonds are we going to be issuing? What sort of collateral is going to be put up? Any repayment arrangements? If there's going to be issues potentially in the company's cash flows, call provisions, right? So that's actually really important when there are changes in interest rates. And so because a bond issuer is required to pay the coupon on a bond, if interest rates drop significantly, then it would make sense for the bond issuer to try to restructure that debt issuance. So like we see with the Federal Reserve now starting to drop interest rates, it's very likely that companies are going to start considering calling bonds and reissuing bonds at a lower rate. Right, so call provisions might be included, and if that's the case, then the bondholder is going to be paid a premium with the par value being paid out a little bit early. And that's going to get the bondholder a little bit of a return, and it's going to provide the opportunity to save some money for the bond issuer. And then also protective covenants that are going to go on the bond just to help make sure that this capital isn't going to be misused. All right, so in particular, if a bond is going to be issued, it can be issued in registered form where there's a record who holds the bond, and then the bearer form, right? And if you've seen Die Hard, you've heard of a bearer bond, and I hope you've all watched Die Hard at this point. If you haven't, great movie, right? But bearer bonds, these are the things that Hollywood villains are often trying to find because whoever physically holds the bond can claim the cash flow that's tied to that bond, right? One of those untraceable sort of things. With the registered form, it's basically like the blockchain that became really popular. There's a record of who owns the bond, who's the legal recipient to the cash flows tied to that bond, right? And whoever the legal owner is receiving the bonds. So even if someone would come and steal all these registered form bonds, it wouldn't matter because the original owner could say, hey, these were stolen from us. Don't pay out anyone else claiming them. Whereas bearer bonds, whoever physically holds them can claim the cash flows. Right. Then there's different types of security that bonds might have. So there's unsecured debt, which means there's no collateral involved. Right. So unsecured debt is usually riskier than secured debt because there's no underlying collateral that's going to be claimed. Right. When you take out an auto loan or a mortgage, very often the collateral is going to be the item that you're taking out the loan for. Right. So if you have a mortgage, the bank can take back the house if you start defaulting on your mortgage. And similarly, the bank can claim your car if you stop paying your car payments. Right, so unsecured debt is usually riskier, usually has a higher interest rate, but there's no asset tied to that debt if it were to go bad. So that's going to be a longer term, greater than 10 years, typically unsecured bond. And there are also notes. These are a little bit more common for large public companies. Notes are unsecured shorter term debt. And then there's also levels of cash flow seniority. Right, so junior interest has a lower claim to a company's cash flow than senior debt. So the basic idea is if a company makes, let's just say it's $100, senior has claim to the first $50, junior has claim to the next $50. So if for some reason the company only made $75 in that year, then the senior would get all 50 of their dollars, but the junior would only get $25. Right, so that's the importance of seniority. More senior claims to a company's bonds have higher claims to the company's cash flows. So if for some reason there's a shortage, more junior claims to the company's cash flows will get, I'm trying to think of an appropriate term. They will make a loss on that second year when the company starts making less money. Right, so having a more senior claim to a company's cash flow is a little less risky of a position. In other words, different tranches of cash claims. And usually it's not just senior and junior. Very often there can be multiple levels of claim to a company's cash flows. All right, and those covenants that I mentioned are things that companies can or can't do with the capital that they're going to be raising. Right? So there's positive covenants or things that companies will do. That's going to tell bond holders, the people providing capital, what that money is going to be used to do. right? So some things that you might commonly see: maintain working capital at a given level, especially on shorter term debt issues. If it's going to be used to audit financial statements or maintain collateral for another outstanding loan. And then there's also things that bond covenants can mention that companies won't do. For example, they can't use this capital to pay dividends. They can't use it to pledge assets to other lenders, right? So in other words, basically leveraging collateral across multiple loan issues. They can't use it to go in a merger or sell these assets without approval, or use it to basically help reissue longer term debt that the company might be interested in order to kind of improve their capital structure. Right, but the basic idea behind protective covenants is basically just helping or ensuring that the bond issuer is going to receive their payment and that the capital that they're borrowing won't be misused. Right, there are also various types of bonds that we see. The main forms are government and firm. So government issued bonds are one of the largest, especially in the US, one of the largest markets in the world. As of this morning, U.S. public debt is $35 trillion. And the total U.S. Stock market value as of July of this year was $55 trillion. Right? So this single entity, the U.S. government, holds $35 trillion in debt, and the total U.S. stock market value is $55 trillion. And keep in mind, actually, I should have put some information on the total value of the firm's bond market. But right, stock markets are only a fraction of companies' outstanding capital. Usually it is the majority of a company's capital structure, but still, right? U.S. government holds $35 trillion, which is about 3/5 of the value of the total stock market value for the U.S. is a pretty substantial size. And we also have corporate bonds issued by companies. And some other particular forms of bonds, the zero coupon bonds, which are just pure discount. And there are also floating rate bonds, right? So typically, and the examples that we're pretty much going to be dealing with are going to be fixed payments, but floating rates basically allow coupon payments to adjust along with interest rates. Any questions so far on bonds? Yes?
Are floating rate bonds quite common, or do they interact with like government bonds, or
That's a good question. I don't remember. I mean, if we just look at the U.S. government, I'm pretty sure the vast majority of U.S. government, if not all of it, is fixed rate. So just by that fact alone, most of the bond market is fixed rate. I'm pretty sure most companies issue fixed rate as well, but I don't remember what portion. Yeah, good question. Anything else?
So with interest rate, I know you said you can't give financial advice, but super recently with like interest rates lowering like the 5 points or whatever, bonds are going to be like better for like investment strategies, right?
It depends what you're doing and what you've done in the past. So for someone that just buys and holds a bond to maturity, higher interest rates are better because, when you're buying and holding onto that bond, it's just going to pay out more over time. If you've previously purchased bonds at a higher interest rate and market rates have dropped, then the value of those bonds will have increased. And so if you're interested, you could sell those bonds at a premium for a higher rate of return. If you can reinvest in something riskier like equity or real estate or something like that. But declining interest rates are usually not a positive effect on savers, but it is positive on borrowers and spenders. So in aggregate, it's kind of a mix, and it's not good or bad. It's kind of, it depends.
Okay, so like it's better for borrowers. Lower interest rates are better for borrowers because they're paying less than what they would have borrowed.
Yeah.
Okay.
Exactly. And on the flip side, savers, right? If you put money in a high yield savings account, those high yield saving account interest rates are going to start declining along with interest rates more broadly, right? So from an investment side, it's not necessarily as good for savers. how it affects people who invest in equity is a little bit iffier. There used to be an inverse association between the bond market and the stock market. That's basically gone away over the last decade. So now it seems like changes in interest rates aren't necessarily affecting companies, or at least equity holders in companies significantly. Yeah. Any other questions? Yeah, unfortunately, the more I learn about these things, it's not necessarily good or bad decisions. There are some very good decisions you can make, like saving and investing over the course of your life, especially as early as you possibly can. That's a categorically good thing. And then there are categorically bad things, like taking out payday loans and not paying off your credit card every month. Those are not good things to do. But in between those kind of spectrums, it's kind of it kind of depends on your situation. So the changes in interest rates, generally good for borrowers, not as good for savers. But if savers are willing to reallocate into other asset classes, it won't have a significant negative effect on them. All right, and so we can also check out, let's take a look at this. So this link is for the US Treasury. I don't like using Edge. All right, so this is Treasury Direct, right? Basically the US government's website for buying and selling bonds. Right? Basically telling you that's exactly what you're doing. When you buy a US savings bond, you're lending money to the US government, and the government agrees to pay that much money back later, plus interest. Basic definition of a bond that we've already talked about, right? Right there at the top of the website, $35 trillion market, and they can sell for as little as $25 at a time. All right, so very quick and easy way to go about looking at bonds. They also tell you the interest rate on different stated bonds that are available. All right, so let's see. Yeah, inflation hedge bonds are something that people are particularly interested in, right? So retirees want to maintain purchasing power, and like I mentioned, real cash flows versus nominal cash flows. This protects a person's purchasing power. They changed the face of this a little bit. Let's see if I can. There we go. All right, so this is just giving more interest or some more information about T-bills, right? These are the short-term bonds that the U.S. government issues, right, from 1 month to 1 year time periods. Also details information about how the minimum rate of return, or the minimum amount you can invest and the maximum amount you can invest. I was trying to find, they used to have just a page outlining the average rates. But I haven't looked at this webpage in a little bit, and it's changed.
Like rates over time, like with years and stuff, or
Yeah, like recent issues. There we go. So is it auctions and announcements, data, and results? All right, so the recent 1 month auction issued or is about to issue will have an interest rate of 4.7%, right? And you can look at different time frames for bonds that were being issued. So let's see if we have a longer bills. Let's look at the bonds. All right, so a 30-year bond that was issued last month went for 4%. All right, so you can basically look through this and see different rates of return for the different bonds. And you'll typically see the inflation-protected securities have lower rates relative to the nominal returns, basically the difference between expected inflation over that time period. All right, so lots of information readily available. Treasury bonds are readily accessible and invested in. If you're interested in setting up an account, this is one of those options available. All right, and there's also state and local government issued bonds. Typically, municipal bonds are tax-free, right? So these are going to be particularly popular with individuals that have a higher tax rate. So unlike equity markets that people are a little more used to looking at, bonds are over-the-counter purchases, right? Basically meaning that we're dealing with brokers and dealers who are bringing together buyers and sellers rather than there being an open market for people to pull quotes from and execute trades. Although it is interesting that the bond market is larger than the equity market in aggregate, right? We saw that the U.S. government is about 2/3 the size of the total stock market in the U.S., and that's just one borrower in the market here in this country. Right? Companies themselves go to the bond market a lot more regularly than they go to the equity market when they're raising money. And so the bond market is much larger, but it is less liquid. So a little bit about people facilitating these trades. We have brokers. These are people that buy or sell orders on behalf of investors, and they can act as agents of accounts. We also have dealers that basically they're working on their own account or their employer's own account. And then broker dealers, so they can buy for themselves or on behalf of others, and they're the basic idea of a stock brokerage that we typically look at. When we're looking at the market, there's going to be a difference between different types of prices that we're looking at. So there's the bid price, or what we can sell at, and the ask price, which is what we can buy at. And then the bid-ask spread is how much money that these market transactors or market participants are earning in order to facilitate this trade. Right. So typically the bid is lower. Oh, that is what it is. The bid is lower than the ask, and the spread between the bid-ask is where these market makers are earning their money. In general, the more liquid a market is, the lower this spread will be. Right? So in the stock market, it's gotten to the point where we can find fraction of pennies on the most liquid stocks, whereas other markets, typically the spread can be substantially higher. So in the bond market, there's relatively little transparency relative to equity markets. So even though that the bond market is larger, because transactions are private between broker dealers and there's no centralized reporting, the market itself is a little bit less, or not a little bit, it is less transparent than the equity market. So a necessary thing for markets to be efficient and transparent is that there are more market participants or very active market participants, and they're constantly reporting the results of their trades between one another. Right? So a good example of illiquid and fairly untransparent market are real estate. Right? People tend to buy homes for themselves, and that's not a frequent change. Right? Buying and selling a home can take a lot of time and takes a lot of money. So typically when you look at an area, right, people are purchasing once, maybe every couple of years, usually over longer time periods. So there's fewer people transacting within that market. And the fewer people there are transacting in a market, the more difficult it is in order to get an efficient price out of the market. All right, so because with the bond market, there are a lot of people that are just buying and holding a bond through maturity, right, there's not going to be active trading going on, or not as much active trading going on. All right, so now we're going to start working toward some examples on calculating bond value. And the main things that we're going to look at are changes in yield to maturity and the coupon rate, because that's what results in changes in a bond's price. Right? So if there's a change in a bond's discount rate in the open market, that's going to change the bond's price in order to keep it equating the coupons and the par value being paid out. Right, so in other words, yield to maturity is the current open market risk, and coupon was the risk estimated when the bond was initially issued. That's why I was talking about when we're looking at the 5 and 10%, this is what is contractually tied to the bond and what the bond issuer has to pay. And the 10% would be what's available on the open market for similar levels of risk. All right, so one more reminder, actually, we'll do some examples and then give the reminder, break up the ideas. All right. So now we're gonna hop over into Excel. We're now on the Unit 3 page under the bond section. All right, so let's say that we receive a bond with a face value of $1,000, yield to maturity of 5.5%, and matures in 8 years. What is the bond's price? All right, so this is a pure discount bond. There's no coupon being paid out. It's compounding annually, just once a year. So let's go ahead and use the function for calculating this. Can you guys remind me, walk me through how we are going to use, what time value function are we going to use and how we go about that?
Is it the final value?
I heard a couple different things.
Final value?
Final value? No.
Present value.
Present value. Yeah, right? Price, present value.
Okay.
Par, future value. Face value, future value. Compounded, future return, retirement value. Those are future value questions. When we're trying to find the value of something today, that's a present value problem. We're trying to take a future cash flow and figure out what that's worth today. All right, so we're going to use the PV function. All right. Again, it's just a time value problem. All right, so we need the rate, the yield to maturity of 5.5%, the number of years, 8 years. Is there a payment on this bond? Correct, no. So we can go ahead and skip over that. And we have a future value of $1,000. So basically what this is saying is we could pay $651 today in order to receive $1,000 in 8 years. All right, so we can also look at this on a cash flow table. I'll zoom out so we can see the whole table. All right, so look, this is the timeline that we're dealing with. We have a bond that is maturing over 8 years. In 8 years, it's going to be paying out $1,000. We can get our discount factor, 1 divided by 1 plus our discount rate, raised to the year. All right, we get the price same way we've been calculating. We take the discount factor, multiply it by our price, right, and we should have the same answer, $651. I'm just showing the timeline now of this par value being paid out. Any questions on calculating the bond value? Yeah, just a present value problem like we've already gone over. All right, let's get a little more complicated now and add in some additional information. So, what's the bond's value if it matures in 20 years with $1,000 par value? It has a coupon of 6.5% and a yield to maturity of 5.5%, and compounding annually. All right, so now we have some more information. We've got a coupon, we've got the yield. Which one of these is our discount rate?
5.5.
Yeah. The yield to maturity is our discount rate. The coupon is our payment. Never mind. Yield to maturity, discount rate. Yield to maturity, 5.5%. That's going to be our discount rate. The coupon, 6.5%, is going to be our payment. All right. So, price or present value, face value, future value, coupon, payment, yield to maturity, rate. All right. So, same thing. Still just use the present value. So now we're going to have a rate of 5.5% and compounded annually. We've got a 20-year time period. Now we need to calculate our payment, right? 5.5% or 6.5%. That's our rate of return from par. So we have to take this 6.5% and multiply it by the face value. That's going to get us our payment. I forgot to put a negative sign on here. That fixed. And lastly, we've got the future value of the bond being paid out. So the bond's price is $1,200, right? Exactly what we should expect when the coupon is greater than the yield to maturity. When the coupon is greater than the yield to maturity, the bond holder is going to have to be paid an incentive to let go of that return that's greater than the market return, which is what we see in this example. The bond holder is earning 6.5%. The market would get 5.5% for a similar bond, right? So if you're earning 6.5%, and if you exit that investment, you're going to earn 5.5%. You're going to have to be paid a premium in order to make that exchange. So now we're going to look at this in a cash flow table. So this is a little too, I should have used a shorter time period. I don't know why I used 20 years. It's just a little bit of a hassle to put in here. But anyways, all right, we're going to put in the information that we need. We're going to get the par value, which is the future cash flow being paid out. That's going to be equal to the $1,000. Then we need to get our coupon. So the coupon is going to be equal to 6.5%, fix that reference, times $1,000. All right. In other words, we're getting $65 in interest every year over 20 years. We got our $65. We'll get our discount rate, 1 divided by 1 plus our yield to maturity of 5.5%. Now we can get our present value, which is going to be our par value plus any coupons paid out times our discount factor. And sum it all up, and we should arrive at the same answer, which we did. Any questions on calculating the bond price? This problem?
The 6161. You said you did the.
So it's the cash flows times the discount factor. So same exact strategy we used on our previous cash flow tables. But this time the cash flow is the coupon, and in the last year, the par value.
Okay.
All right, so the 6161 is just the discount factor times the coupon paid out in that year.
Okay.
You had a question?
I have a
Okay.
question.
I just went ahead and in this first year added together the par value because it's 0 until that last year. But in this last year, that's when it gets added in. Okay. In this last year, we got the $1,000 par value being paid out, added in with the coupon. Any other questions? What's the bond's value if it matures in 20 years with a $1,000 par value, has a coupon of 6.5% and yields maturity of 5.5% and compounds semi-annually? All right. So now we've got the same problem set up. The only difference now is we're compounding semi-annually instead of annually. Right? So what do we think is going to happen to the value of this bond with this additional compounding period? Yeah, it's going to increase. Right? As a borrower, the more frequently we can compound our investments, the more it's going to be worth to us today. Conversely, as a borrower, the more frequently we compound our borrowings, the more costly it's going to be. All right, so using the present value function, we're going to have the rate, and again, what's the discount rate for a bond? Yeah. In other words, the yield to maturity. So we have the yield to maturity, and I got a reminder on the adjustments we have to make here, right? So we're going to divide our coupon by the number of periods, divide the rate by the number of periods, and multiply time to maturity times the number of periods per year, right? So for compounding semi-annually, that's 2 compounding periods per year that we're dealing with. So we take the rate and we divide it by 2, take the number of periods and multiply it by 2, and now we've got to calculate the $65. Right, so it's going to be $32.50 every 6 months rather than $65 every year. All right, so it's still $65 per year, but we're compounding a little bit more on that first 6 months because we receive that $32.50. All right, so we'll calculate, actually, before we get that, get our negative sign. So we will calculate our coupon payment, which is going to be divided by 1,000 and divided by 2. All right, almost there. Last step, put in our face value, $1,000. Right. So as we expected, it's worth just a little bit more. Right? We're compounding one time more frequently, so the value of the bond went from 1,119 to 1,120. Right, and if we compounded, let's say monthly instead, right? Again, we'd see the value increase a little bit more, maybe every day. Again, the value increases a little bit more. Right? Okay, so I got to remember to shorten the time period and not make this so much of a hassle, because now that we're dealing with this semi-annually, technically there should be 40 periods per year. Do you guys want me to do this problem? All right, let's go through it. So we've got, we'll just highlight these last two. Excel is fairly smart, so once we highlight it, it'll automatically count out what we need. So we got our 40 time periods. Yep. That's why I asked. And we'll go ahead and highlight make sure it's all there. All right, just so we know where we're calculating our info. So our par value, right, in this last time period, remember these aren't 40 years, these are 40 6-month intervals, right? So we're still dealing with 40 years, but we're compounding twice per year. So that's functionally doubling the number of periods that we're dealing with. All right, so we've got the $1,000 payout in 46-month time intervals. Now we're going to get our coupon. That's going to be nope, it's not. It's going to be our coupon divided by 2 times. Actually, let's multiply it by future value first. All right, so $32.50. Fix those references. Actually, we can make this a little better and reference the number of compounding periods. Even better. All right. We've got our coupon. Now we'll get our discount rate. 1 divided by 1 plus our 5.5%. Fix that reference. Divided by the number of compounding periods, 2. And raise to the year. And we'll get our present value. So par plus coupon times discount. And if I mess something up, I'll give up and work on it in my office and send you the answer. All right, let's see. Hey, it worked out. So just expanded with the cash flow table here, right? We're still dealing with 20 years. But we're dealing with semi-annual time periods now. So we have 40 semi-annual time periods still within 20 years. But again, right, it's just changing the cash flow table to accommodate that. So we double the number of time periods. We have the payment because it's now every 6 months rather than every year. And again, we're having the discount rate that's applied to our discount factor, right? Remind you what I did in here. I just divided our discount rate by the number of compounding periods. Same thing we do with the time value of money function. The only difference now is we're applying it in a cash flow table rather than the function. Any questions on this example?
So whenever you give us like a problem in the homework or quiz similar to those questions, doesn't matter which function we use, right?
So for a question like this, I would recommend using the function over the cash flow table.
Right.
Right. The benefit of the cash flow table is it's more informative,
Right.
which we'll see at the end of this term when we start dealing with more expansive cash flows. It's a lot more valuable to be able to see the expanded version of a cash flow table. But when we're dealing with constant cash flows like we are with a bond, much easier to use the function.
Right.
Yeah. So I do recommend the function over the cash flow table for bonds specifically.
Yeah, because I think on maybe homework too, for some reason I was thinking I needed to have the table But anyway, I was just making sure.
Gotcha. So you can always use the cash flow table. That's
Right.
that's one thing that I like about them. They're applicable for all time value situations. Every single one is applicable with the cash flow table. With the function, it only works for constant cash flows. You can't use growing cash flows. You can't use regular cash flows, so those can be problems. What else? And then there's also the formula, which I ignore a lot of the time because it's a lot easier to mess up. There's a lot going on when we're using annuity formulas, so it's very easy to mess something like that up. But that's kind of like an in-between the ease of the function and the time consumption of the cash flow table. But again, it requires consistent growth rates to use the formula still. Whereas again, with the cash flow table, it doesn't matter what you're dealing with. You can throw it in the table. Yeah. So you can always use the cash flow table. It's not always the easiest though.
Right.
All right, so now we're going to look at calculating yield to maturities. All right, so this is similar to using the rate function to calculate the rate of returns. Only difference is the information that we're using to calculate is, do I keep hitting, like, do you see it bouncing the screen? Okay, it's not just my eyes. So it's going to be similar to using the rate function, but we're going to use specific information that's going to be a little bit different in this situation. So we're going to use the yield function, right? So it returns the yield on a security that pays periodic interest. Great. That's exactly what we're looking for. So it's asking for, okay, so we're going to use the rate for the first one. We'll use the yield on the second. Yeah. So we use the rate on this first question and the yield on the second. So the reason I realized I was applying the wrong one is the yield function requires dates for the settlement and maturity time period, right? So that information was missing on this first problem here. So we'll just use the rate function for that. All right, so for the yield function, this is something that can be used when looking at bond quotes. It'll tell you when are you planning on purchasing this bond? When is that bond maturing? And it's asking for the coupon rate, price, and redemption. So there is one adjustment we're going to have to make here. This is just for bond-related functions. It requires it to be in hundreds of dollars. This is another one of those antiquated aspects within financial calculators, right? Bonds are issued in thousands of dollars, so naturally the bond calculators require hundreds of dollars formatting. What am I missing? Oh, frequency. Divided by 10. We'll just say it's, annual. There we go, right? So when the price is equal to par, we should expect to find that the yield is equal to the coupon. Right? Again, if the price is greater than par, then the coupon is going to be the coupon is going to be greater than the yield, and so the bonds can be issued at a premium. And conversely, if it's sold at a discount, then the coupon is going to be less than the yield. Right? But because price is equal to par, we should expect the yield is going to be equal to the coupon, which is what we got. Any questions on calculating yield using the yield function? Yes.
Why do you divide it by 10?
And an unfortunate just convention of financial calculators. So it needs this information, the price and the par value, in hundreds of dollars. It's a frustrating convention, but it's just what it needs. Yeah. So when you use the yield function, you have to put the $1,000 divided by 10 to get it in the hundreds. Yeah. Anything else?
And what does the number 1 stand for at the end?
Oh, yeah. So I forgot to put a separate cell here for the number of compounding periods, so actually I could just add that in. Right, so it's asking for, you need to specify what is the frequency. Is it compounding annually, semi-annually, or quarterly? So we'll just go ahead and reference this. So what is its compounding frequency? Any other questions? All right. We'll go back to the question I started messing up. So this one's just going to be a rate function question. Oops. Reminder on the definition, right? Returns the interest rate for a period for an investment. Example, 6% quarterly payments at 6% APR. So our rate is going to be the number of periods. Do we have a payment? No, 0 coupon. We've got present value of 800 and future value of 1,000. So using the rate function will get us 2.83%. Any questions on rates or yields? Oh, yeah, what we were looking at, right? So in the example that we did, we saw that price was equal to par. So whenever that's the case, we should find that the coupon is equal to the yield to maturity rate, which is exactly what we saw in our example. Right down here, we had price equal to par. And when we calculated the yield, it was equal to the coupon rate. All right, so that should always be the case when we're looking at a bond value. When the call is greater than the yield to maturity, the bond's going to be selling at a premium. If the coupon is less than the yield to maturity, the bond's going to be selling at a discount, right? Again, think about the economic rationale behind it. There's the mechanical relationship, but economically, if you have a 5% bond and people can purchase a 10% return bond, obviously you're going to have to provide some sort of incentive if you want to sell that bond. So you'd have to sell it at a discount. So whenever we see a bond's price change, right, the cash flows aren't changing. The bond, it's a fixed income instrument, so the cash flows aren't changing. What is changing is the discount rate that's applied to those cash flows. Right? And there's always an inverse association between discount rates and present values, or in this case, explicitly prices. Right? So whenever we have a change in the discount rate, we'll see a change in the price. So as the yield to maturity increases, the price is going to decrease. Oppositely, if the yield to maturity or discount rate decreases, the price is going to increase. There's always an inverse association between present values and discount rates. The sensitivity of this change is going to be based on the coupon rate and the time to maturity. Right, so the higher the coupon rate is, the lower the sensitivity, and the higher the time to maturity, the higher the sensitivity. Right, so the basic idea here is how early or how soon are we getting the cash flows from this bond? The earlier we receive our cash flows, the less risky those cash flows are, right? Everything else equal, the earlier we can get our cash flows, the less risky those expected cash flows are going to be. So when we have a bond with a higher coupon rate, we're getting cash outflows earlier in the bond's life. If we have a shorter time to maturity bond, that bond is going to mature before, the unknown future really starts going potentially crazy. Great example, Apple is one of the largest, most profitable companies in the world right now. 5 years from now, that's a pretty good chance that'll be the case. 10 years from now, not entirely sure, maybe it'll still perform well. 20 years from now, we really can't say whether that's going to be the same company that it is today in terms of its market power. Right, so the further we go into the future, the more inherently uncertain and riskier those future cash flows are. The earlier, and conversely, the earlier we can get our cash flows, the more likely it is that we're going to receive that money. So some things that we can use in order to gauge the riskiness in the bond market are credit ratings, right? So these are similar to our credit scores. Unfortunately, companies don't have the same scale, so there's a whole other scale that we have to consider. But basically, a bonds rating is supposed to reflect the borrower's ability to repay on their loans. So we have investment grade and junk grade. Basically, it's called investment grade because this is what a lot of investment funds that people in their retirement accounts might see available to them. And these are across two of the most common ratings, S&P and Moody. They have a similar rating scale. Unfortunately, it's slightly different. Another annoying convention within the market. So it starts from AAA on down to BBB. Double B is now where we're going from investment to junk. And then from B down, we see the junk grade bonds, right? So as we go down the scale, it's basically you're guaranteed to receive your money back all the way down to this company is in default right now. And if you lend to this company, you're unlikely to get your money back. Or this company or this government, right? Governments can default on their debt as well. All right, so this rating scale is basically just what's the probability of you getting your money back. The higher up you are on the scale, the more likely you are to get your money. A really interesting time change is companies used to really try to get to this higher investment grade, right? It signaled that they were a safe, secure company to invest your money in. But over time, companies realized that they were spending more money and effort in trying to maintain this status, and the cost of maintaining that status was greater than the benefit of the reduction in interest that they would receive on their debt. So companies stopped focusing on being AAA. We're at a historical low, AAA rated public companies, but companies are not defaulting at a higher rate because of this change. They're just not clamoring to be in that highest graded rating. Now that interest rates have increased and it's become more costly, the math might change a little bit, but especially when interest rates bottomed out from quantitative easing after the last Great Recession, it just wasn't worth the cost to a lot of companies. It's important to keep in mind these ratings aren't perfect. A great example of that is they were in many ways manipulated a bit in the run-up to the Great Recession. Companies pay rating agencies for their bond ratings, right? So try to think about incentives here, right? If Apple is paying S&P to rate their bonds, does S&P have more incentive to make Apple happy, who's paying them, or the consumer who's not paying them for this information? It's an unfortunate incentive structure. One of those things, I think credit ratings in general in this country are pretty skewed in the motivations and general cash flow structure. But the companies that are making these ratings have very strong incentive to provide companies with the credit rating that they're looking for. There's also a lot of overlap between ratings and interest that's charged, right? So it's possible to see a company that is AA rated that's paying a lower interest rate than a company that's AAA rated. That's not uncommon to see. So there's a lot of overlap between these bond ratings. So it's not a perfect science. There are some really poor incentive structures within credit rating markets. So just a thing to keep in mind. It's a good thing to glance at, right? The difference between investment and junk grade is pretty clear and is much stronger, but within investment and junk grade bonds, the difference in ratings isn't as valuable. So this is an old news article, but it's something that's kind of trailed on for 5 years. And I believe now the last company that's included in this, or the last country that was included in this graph has changed their rates with Japan. But some countries went into the negative rate territory for a while, which is a really interesting thing when you think about that, right? Because basically what it's saying is that you're paying a bank to hold your money with the bank, rather than the other way around, where a bank typically is going to pay you for holding onto your money. The basic idea with these negative rates is it's trying to stimulate spending, basically, right? So the goal of having a aggregate government level negative interest rate is to incentivize spending, which in advanced economies usually makes up around 2/3 of economic growth. Right? So in the US, about 70% of our GDP is based on consumption or consumer spending. So if people are choosing to save rather than spend, that's basically a cut to our overall economic growth. So the idea behind negative interest rates is if it's now more costly to save your money, you're more incentivized to go spend that money instead of save it, right? That's our basic two options. We can either spend money or save it. So if saving becomes more costly for us, the other option is, well, yeah, we could hold it under the mattress, but people tend to spend money when they have it on hand. And so that's the basic idea with these negative interest rates, is to try to stimulate more economic growth. All right, so you're going to be a lot more likely also to borrow because interest rates are a lot lower. On the flip side, it's still uncertain how that interest rate environment would affect if there is a recession, right? So the basic idea for monetary policy is to manage interest rates in order to improve or deteriorate spending environments, right? So when you cut interest rates, it's easier for people to spend and invest, companies at least in terms of debt issuance. And so typically what central banks are going to do is cut interest rates in the face of a recession, right? And so if it's a very large recession, they can cut interest rates a lot, and that's going to help stimulate spending further. But if you're already in the negative interest rate territory, there's no precedent for understanding what monetary setters can do in that situation. All right, and so the basic idea is countries should really use this as a last-ditch effort to try to stimulate spending. We don't know what the long-run effects really are still. Likely there's going to be a lot of research coming out for the effects of these policies over the last 5 years. I actually got to catch up on bond literature. I typically don't pay attention to that market as much. But it can also incentivize people to hold cash in hand rather than spending in general, which is the worst of both worlds because it's not being used to generate loans and help investment, and it's not being used to consume things. So if people are just holding cash in hand, that's the worst possible outcome from any monetary policy decision. And it also significantly reduces bank profitability, right? As interest rates increase, banks tend to become more profitable. So that also just guts banks. All right, so that's it for today. So next class, we're going to talk some more about bond structures. Are there any questions before we get going? All right. Oh, yeah. There's a big storm coming. I didn't realize this till today, but we basically have a hurricane that's coming up, and it's probably going to be a tropical storm around the time it hits Tennessee. Yeah, tomorrow. And I've never seen this before, but I grew up in Florida, so I'm kind of used to hurricanes at this point. But basically, the storm's coming up to Kentucky and then stopping and reversing back. So it's going to be hovering over us for a couple days. So yeah, make sure you get any grocery shopping or anything you need done today. And get ready for high potential for flooding this weekend. I think we're getting like 6 inches of rain the next couple of days. So yeah, be safe, have a good weekend, and see y'all on Tuesday.
Get your milk, eggs, and bread.
What's that?
Your milk, eggs, and bread.
Yeah. Before storms in Florida, that would like all sell out.
Yeah, that's how my mom would always talk about because she used to go to school in Florida.
That's why I go for freezer foods.
Yeah.
They last longer and people don't buy them up right away.
Have a good afternoon.
You too.
Okay, so this is my fault, but I still figure it's worth asking.
Okay.
I did not go to 4 decimal places for
Okay.
this question.
Yes.
And I managed to see every part of the question. And I just assumed the 2 decimal places. Is that still